Tech stocks leading gains in the market, but my next guest says the narrative around AI capital expenditure is becoming more skeptical. Let's go to Peter Berezin, Chief Global Investment Strategist, Director of Research, BCA Research. Thanks for joining us today.
It's good to be on. It's good to be on.
You say we may have reached a metaverse moment. Can you explain?
Well, if you recall what happened in 2021, Meta got punished by investors for spending too much money on the metaverse. And then, not surprisingly, they stopped spending money. So what I think will probably happen next year is that we will have a similar occasion where some big AI company announces more capital spending on AI and its stock price goes down. And once that happens, you're not going to see too many more announcements. And unfortunately, the economy has become so addicted to all this AI spending that if we go from kind of the boom in capital spending on AI to a bust, that could drag down the whole economy.
Okay, so I feel like we've already started to see that, right? Where we had NVIDIA with a beat and then stock went up for a very short period of time and then came back down. And there seems to be questions already about whether there is return on those investments. But you think this theme is going to play out even more so next year?
I think next year is when sort of the rubber hits the road. I think next year is when investors will get very much disillusioned with the whole AI narrative. Not because it's not going to lead to efficiency gains. Of course it will. AI is super useful, but that it's going to be very difficult to monetize it. And I think as investors begin to focus on that angle, you're going to see a pretty big sell-off in stocks, perhaps a big enough sell-off that this hurts the economy, pushes it into recession, very similar to what happened in 2001. That recession was more the result of a stock market crash than the cause of one.
Are the large language models, which most of us are now familiar with in some way, shape, or form, are they profitable yet for these companies, or is that part of what is holding tech back, you think?
Well, they're certainly profitable for NVIDIA, but they're not really profitable for anyone else. And that I think is a real issue. I mean, if you look at the sort of spending numbers that the hyperscalers have announced, if you take these numbers seriously, they're on track to hold something in the order of $2 trillion in AI assets by 2030. Now, the depreciation rate on those assets is fairly high. It's around 20%. So 20% of $2 trillion is $400 billion in annual depreciation expense. And for reference, the combined profits of the hyperscalers, Microsoft, Meta, Google, Amazon, and Oracle, was actually slightly less than $400 billion this year. So unless they can really grow those revenues and profits, we're talking about a lot of unprofitable investment. And eventually, investors are going to punish those companies for this sort of spending.
What do you advise investors should do for the end of the year? We've already seen some rebalancing, movement away from tech to other sort of more cyclical shares or companies that have sort of better bottom lines for a longer history. What are you advising investors to do?
Take some profits. I mean, don't go fully defensive because we're probably not an imminent risk of a recession, but take your profits, move a little bit to the sidelines, because at these valuation levels, I mean, even if you buy the whole AI narrative, at current valuations levels, historically, future returns, like over a 5-year horizon, have been very, very low. So you're not really getting paid to be in this market. There's just not a lot of upside left, but there certainly is a lot of downside if the whole AI narrative really begins to crater.
Are you on side with a rate cut in the U.S. For December? And if you are, why?
Oh, I think the Fed will cut rates. And that's partly because of political pressure, but I think it's more because the economy needs rate cuts. And we haven't had any job growth now for about 3 months. Like the latest ADP numbers point to job losses in the private sector. Wage growth has stalled out. Job openings have been trending lower. Perceptions of job availability from the Conference Board survey, from the University of Michigan survey are very, very weak. So this is an economy that's actually struggling despite the stock market boom, despite the AI boom. If you didn't have those things working for you, you'd probably be in a recession already. So I think the Fed should be cutting rates, and I think in December they will.
Peter Berezin, I've got to leave it there, so thanks for joining us. Appreciate that.